Hi, everyone. Welcome to Bonds 101, Surety in Ontario in 2022, presented by Gifford Carr and in partnership with Trisura. We are just waiting for everyone to get online, and we'll get started here in a couple minutes. Kat, you think we're ready to go?
Yep.
Perfect. So again, welcome to Bonds 101, presented by Gifford Carr. Today we're going to have a fun little chat about surety bonds, a complicated, highly technical piece of insurance that often people aren't quite sure what they're getting, and something that not every broker is well versed in. So something that's important for us to sort of get behind the scenes and understand with it. And thankfully today with me, I have one of our experts that we deal with, Andrew Romer. Andrew is the Vice President of Surety for Trisura Guarantee. He's been in the industry for 15 years and brings into experience in a current role where he oversees the organization's contract surety operations in the Ontario region. Andrew joined Trisura in 2013. Prior to that, he was an underwriter, both in P&C insurance at a global insurance company. Andrew has a Bachelor of Science and Business Administration with a focus on insurance, finance, economics, finance from the University of Hartford. So, Andrew, thanks for joining us today. Much appreciated, my friend.
Appreciate you having me. That's quite the mouthful. So I know I'm looking forward to this. And you mentioned a fun conversation on surety, and we'll try to make it as fun as possible, especially a Friday morning here. Looking forward to kind of run through a few things.
Yeah, absolutely. So let's jump right into it. Sort of just going to go over, do an overview of what the webinar is going to be about today. It is Bonds 101, so we're going to get into some very basic pieces of it to get people started, and then we're going to go over a high-level overview in the industry, and then we have a little bit of time for a Q&A at the end, and we'll see what other questions come up through, keep us on our toes throughout the day. So let's start off. What are bonds? What are surety bonds? This is something that a lot of people just don't understand why, or that it's even an option for them. So I'll turn it over to you. This is the fun one.
Yeah, no, it's a great question. And obviously, yeah, let's start at the beginning, right? And I think where a lot of people get confused right out of the gate is a number of surety providers are also insurance companies. And you got to recognize that there's a difference between insurance and surety. And insurance, it's easy to kind of think of, it's two parties. It's you and your carrier, your insurance partner. And you have a loss, there's a fire, a car accident, so on and so forth. You're paying your premiums, and it's kind of that capacity of the premiums of the many covering the losses of the few. And when you look at surety, it really is trying to look at it more through the lens of a credit facility. It's a three-party agreement where the surety is partnering with the principal or the contractor to support them through their obligations of the contract that they're entering into with the obligee. I like to kind of give the real world example of if a parent is trying to support their kid through purchasing a car, right? And they co-sign on that loan. The loan really is through the teenager or the kid with the dealership, but the parent is there as that safety valve in the background. And that's what the surety is doing. We're there behind the contractor as that safety valve in case something goes wrong.
So, and realistically, that's from a financial standpoint, right? That's the financial backing. I've promised to do something. I want to make sure I'm covered from that. Is that it?
Yeah, the financial, but the obligations as well. So that ties into the contract. So it's the contract that's being entered into between the contractor and the owner, and the bond is supporting that contract and the obligations. So not just the financial aspect of it, it's more of what you're agreeing to in that contract.
Okay, perfect. You mentioned contractors. Obviously, it's not limited to contractors, but when typically would a client need a bond? When is it a good time for them to have it?
Yeah, so in a lot of cases, it's going to be a requirement of the contract. So in 2018, with the Construction Act of Ontario, bonds became legislated for public owners with contracts over $500,000. In a lot of cases, municipalities, townships, cities were already using bonds. This brought a level of consistency in the bond form that was being used, as well a few different tools that weren't there in the past, like a pre-claim or pre-notice to default meeting that the owner can request, and it brings everybody to the table. In a lot of cases, there may just be some airing of grievances or wanting to have that opportunity to be heard and to vent and kind of get through those issues and get the contract going again. So that's kind of one of the areas with it being legislated. In other cases, you may have a sophisticated owner that has some solid risk management tools in place that want to make sure that the funds that they're allocating to a project are protected, as well as they're getting qualified contractors. It may be a requirement from financial construction lenders that they are putting up that money and want to make sure that project's bonded back. And as well, in some cases, you may see a general contractor that is entering a new relationship with a subcontractor or has a critical path subcontractor that they want to receive a bond from to make sure that they're protecting the project that they're on as well.
Are there situations, I mean, you talked about from a legislation standpoint, are there situations though that you might still see contractors putting up their own money instead of a bond? Like, is that something you see much of these days? Obviously, we're talking about large sums of money, but I've seen many situations where clients just don't have it, and they don't realize what they're doing, putting up their own capital.
Yeah, like I said, for the legislated projects, those are going to be $500,000 or larger. But even in those cases, there was that kind of adjustment period where certain municipalities or owners may have been kind of slow to the charge and picking up what those requirements were. So there are cases where you're seeing letters of credit being used, and it's definitely an opportunity for a contractor to see those funds being used in their own company for various resources or initiatives that they want to take on. When you're parking that money off to the side with a letter of credit, it's definitely not being utilized the way it should be.
Well, I don't know too many companies that can take, we'll use the $500,000 example and just park that aside, from a cash flow perspective or the availability of capital to invest it otherwise, or start other projects, whatever it may be. Being able to park that kind of money is a luxury, but one that is fairly unnecessary by the sounds of it.
Yeah, and it's going to be a percentage of that 500,000 as an example of what's being parked, but there's a few different things in there. So when you're looking at a bonded contract, you're going to be going up against peers that have gone through the same process that you have. So you're not seeing somebody come off the street that hasn't had to go through the same pre-qualifications that you have. So it eliminates some of the competition that way and kind of levels the playing field a little bit. As well, when you've got a letter of credit in place, if something were to go wrong or there's a dispute, the owner has, has quicker access to those funds. And if there's a bond in place, you've got to go through a claim or a default notice, and there's a chance to protect those funds and have your case stated. So it helps protect those funds as well.
You mentioned sort of the pre-qualification process and having, going through it. I know that there's a higher threshold for a client's perspective. What does a client need to get started with a bonding account? What does that look like?
Yeah, and I think you kind of started off this call right away by saying like it's a specialized tool, right? And it does kind of get lumped in with insurance, but it is a specialized product. So it's finding the right partner.
Yeah.
You kind of go back to the 3 C's of surety is what's always discussed, right? The character, capacity, and capital of a contractor. And the toughest one is probably that character side of things. So having somebody in your corner that can talk about the experience, the resumes, and the approach to the business, understanding that side of it, it's great to have somebody that has that experience in surety to kind of be in your corner. From there, it then goes into the typical list of information that a surety is going to want to see, from the financial statements and the schedules, the accounts receivable, payable, work on hands, and then getting into a questionnaire of understanding the business, how long they've been in business, the ownership structure, and so on and so forth.
You talked about the financial piece. I've had situations where clients have asked for a bonding account, but they're just not willing to give up their financials. Those are tightly guarded. Those are state secrets that a lot of companies just aren't willing to give up. And obviously, it tells a pretty telling story when the financials are either in order or not in order. But is there any way, someone who's in a tough situation or just getting started, like, is that still available for them when you talk about having the capital requirements? We can paint the picture from a character, do our research, but that capital piece is obviously a fairly substantial one, and so are clean financials. So talk to me a little bit about that one.
Yeah, so I guess 2 sides of that is when you're looking at the financials, you're right. It is sensitive information, and that's why it is a little different working with a surety than an insurance company, where it's kind of flooding the market with those submissions to try to see where the best rate is at that time, and you're able to kind of share a little bit more with those companies. Where with a surety, it's more of like a banking relationship. Right? You're looking to build something long-term and have somebody understand your operations. And in those cases where it is confidential and they want to make sure that it only so many eyes are getting access to these statements, we have cases where we'll see the statements directly from the contractor, right? And keeping it limited to who's involved. With regards to a company that it may be light on capital or is in the startup stages, again, that leads more to the story side of things, understanding the resume, understanding what's in the background, what's the game plan, what's the business strategy. That really kind of will help dictate whether or not somebody's going to be willing to kind of get behind it in those early days. As well, maybe there's an opportunity for that individual to partner with somebody else in the early stages. So early stages more on the character side and understanding the personal resources that might be there. But down the road, I totally understand why it might be seen as sensitive and not willing to share some of that information.
Absolutely. You talked about, obviously, from a startup perspective, obviously the market right now, we've seen a ton of M&A, especially coming out of the pandemic, from whether it's contractors, brokers, any industry right now is seeing a lot of acquisition. I remember years ago dealing with a client who had just been acquired, but the company that had done the acquiring could not get a body facility in place. And they had massive contracts with some public entities that they just had to put up their own cash for it because the goodwill was an issue, and or it was just so high because of the acquisition. Maybe talk a little bit about that in terms of mature companies that are now obviously in the process of selling or transitioning. How does that affect their bonding accounts? Again, is that just simply a factor of clean financials?
That's a great question. And unfortunately, in some cases, insurance and bonding can kind of be seen as that last thing on the list when you're going through setting up one of those kind of the succession planning or exit strategy to a business. And it's something that you really need to make sure that you're discussing with your consultants, with your broker, with your legal counsel, with your accountant. We totally understand there's going to be certain situations where you want to limit your liability with potentially creating holdcos, or again, with the succession to the next generation. What does that look like? You got to make sure that you're understanding the implications to the balance sheet and how that may impact for future support. So you're right. It's about getting the right advice and structuring it the right way. So yeah, it's tough to talk about specific cases as something like that, where the support might have been limited. But again, if you're doing it the right way, if it's structured over a time, but we also recognize that unfortunately there are circumstances where something happens, and again, it goes back to the estate planning and structuring it the right way.
You talked a little bit about the advice piece and the having the right team in your corner, and obviously we're firm believers of that. You don't deal with every broker in the province. You don't deal with every broker who writes commercial insurance. You deal with a specialized group of insurers. Why is that?
It's a great question. And part of that is you can't be everything to everyone. And part of what sets Trisura apart is our incredible service and the fact that we rely on our broker partners for the business. Without you, we wouldn't be here. So dedicating ourselves to making sure we're providing a step above service is kind of first and foremost. And also recognizing, since it is such a specialized product, we want to make sure that we're working with people that understand the product. And with what you're doing, these are your clients. You're the one that is out there gathering the information and essentially providing it to us to allow us to underwrite the account. But without that first step, without understanding what's being presented, it just it can lead to friction, and it isn't an efficient way of doing the business. So we've got to be selective with who we're working with.
I couldn't agree more. I think it's very much an industry issue that you're seeing. You're seeing a segmentation with brokers who do commercial properly. Then it's even further with the specialization. And I say it all the time to anyone who will listen, whether it's at the company side, whether it's with clients. It's selling insurance is a financial product, and if it's the left to the last minute, you've dealt with your lawyers, you've dealt with your accountants, but as you mentioned earlier, there's high arching implications to their business, to our business, to everything, that really, brokers need to do a better job of being that advice in the corner for the clients, and having the right relationships with the insurance partners to support in that. And that's, I think, exactly what we have in this case.
Yeah, I think you're bang on.
So, Kat, I'm going to ask you to flip over to the second part of the seminar today. Andrew, we're going to sort of look at a higher level of things. What are you seeing in the industry right now? How's the industry performing? Obviously, it's a little bit different from a surety standpoint, from a straight P&C. So maybe explain a little bit of that difference and what you're seeing.
Yeah. So starting off with the underwriting process with surety, it's, again, you're trying to partner with the right people. And by doing that, if you're supporting the right contractor that has the right experience, the right relationship, the great supply chain management, you really should be able to kind of see those projects through to fruition with no issues, right? So striving to that zero loss ratio on the surety side is kind of the mantra there. But typically, I guess when you look at the surety results over the last number of years, 2018 was a really tough year, where it was the direct loss ratio was over 100%. And that was a couple of big contractors that went under. And then from the last couple of years, it's gone back down into the kind of the normal range. And the attitudes over the last couple of years during COVID, from what I've seen, is there's been a fair amount of understanding, and there's going to be supply chain issues. There's going to be delays on projects with labor, with outbreaks, and so on and so forth. But I think some of that is coming to an end, where owners just want their jobs done. They understand there's delays, but they're just a bit of fatigue to it. So we are seeing a bit more noise. And with that, it's more of the conversation piece of trying to understand what is causing those delays. So when we look at that, it kind of leads in perfectly to the challenges on the horizon. And when you look at the supply chain issues, the ports that are backed up, when you look at different foreign conflicts, there's a number of reasons that are causing these delays. But what's tough is if we get a call from an owner saying, we want this done now, it's not like a surety has a warehouse full of material. we're going to try to work with our contractors to make sure these jobs are being completed. But in some cases, our hands are tied as well. Sorry.
I want to sort of take a step backwards real quick. Just given the process of a bonding account, obviously clients can set up a bonding account. They go through the steps that you talk about. Maybe talk about the differences and the nuances of the different types of bonds. You know, whether it's a pre-qualification letter, a bid bond, performance bond, or a final bond, which we're seeing a lot more of lately. Maybe just, you know, quickly a high-level overview of those different types of bonds and how, given the challenges that are going on right now, how they all might be impacted as we come out of the pandemic.
Yeah, sure. So I guess we forgot to run through that with the specific bonds. But when you start off with a pre-qualification letter, what essentially you're looking at there is trying to see what contractors are going to be best suited for a project, and a surety backing those contractors to a certain level, and understanding what facility they have available to them. They're going to have various other qualifications that they're going to have to meet with experience and so on. But that's kind of the pre-qualification letter from the surety side. Then you get into the bid bond at the tendering stage. And what you're doing there is you're providing comfort to the owner that whoever's bidding this job is going in with the indication that they want this job. So if the low guys or low contractor for some reason is unable to enter into the contract, essentially the owner is looking at it going, well, we kind of thought that was going to be the number. So now we've got to go to number 2 on the list. And that bid bond is going to provide a buffer up to 10% of that bid spread to, again, ease that burden that the owner is now having to take on. So that's the bid bond there, briefly. When you look at the performance bond, that's really the meat and potatoes of what's tying into the contract. So that is looking at the obligations that the contractor is entering into the contract. And that's what the bonding company is supporting. So if something were to go wrong, if there's a default, valid default put in place, the surety would respond through a number of tools that they have available to them, which I think we might dig into later. So that would be the performance bond. And then when you look at the labor and material payment bond, what that's doing is it's giving the owner a sense of comfort that the general contractor that they've picked is going to pay that their suppliers and subcontractors. So it's providing that comfort that if you're working for a general contractor, you know that there's a bond in place in case you're not getting paid.
Beautiful. So then now, as we get into or get to the end of the pandemic, fingers crossed, you know, we've seen inflation jump. The other day, it was reported at 6.7%, the highest since it's been, I think, since 91 was the date that I saw. You know, we're seeing government subsidies that have buoyed the labor, the trades over the last couple of years. Obviously, we still have some supply chain issues that are going through that. What are some of the things that, you know, clients, contractors need to understand, and how does it apply and affect the bonds that they may or may not have in place?
Yeah, so before you get to the bonds, I think it's important for contractors to dig into the contracts that they're going to be entering, right? When you mention inflation, you mentioned fuel costs that are going up, recognizing for longer duration projects, what you bid them at today, is that really going to be the number that the job ends at? So looking to include escalation clauses for fuel, for other reasons. And then as well, looking at the supply chain, working with owners that you're dealing with, going at the beginning, before you enter these contracts, look at these issues. You want this specific material used, that's delayed by how many months? Can you try to look at potential material substitution clauses that gets you out of having to use something that may hold up the whole project? So there's tools around risk mitigation around some of those issues, but you're right, it's becoming more prevalent. And even with looking at projects, if you look at your facility, is a job that was $500,000 2-3 years ago, is that still a $500,000 project today? Right. And is your facility, is your balance sheet set up to support larger contracts?
Yeah, Absolutely. And longer time frames, and do you have the cash flow to be able to justify it? And there's a lot of issues that sort of pop up that you may not necessarily have thought of 2 years ago, but now are forced to,
Mhm.
especially as you're bidding new jobs or trying to take on an increased workflow to get back up and running.
That's exactly it. And if you're projecting a project's going to be quick turning, and you're going to be getting, when you look at the holdback that's supposed to be on the project there, when are you getting those funds released? Right. And if that was supposed to be 3-4 months down the road, and now it's a year and a half, what impact is that having on your balance sheet and your cash flow?
Yeah, absolutely. And I mean, the other part that we need to talk about in terms of there's the inflation, the timeline, labor shortages. I mean, this is obviously impacting the industry as a whole, and really all industries. But again, from a bonding standpoint, is it just the same sort of thing where going into the contract that everyone has to understand that people are tight right now.
Yeah.
The talent workforce is tight. It's hard to bring people up to speed, let alone get new people in. And there's great competition for those senior people or even the mid-level people who are there. So, payroll costs, everything from that standpoint. So again, same question in terms of how does that all affect the bonding market and the industry as a whole?
Yeah. And you know what? I think labor shortages, it's on both sides. So from insurance and surety standpoint, there's a number of open positions that we're trying to find the right people to fill. And it's funny when you look at construction. I know there's a number of labor shortages and positions available, and it's trying to get the next generation interested, right? And and I say, well, is it tougher to try to get somebody to work with their hands and get into construction, or is it trying to sell somebody to get into insurance? It's not the sexiest thing in the world for a young person to look at. But there's a number of great initiatives that are going on out there. It's the job fairs, it's getting involved with schools, the trade colleges. It's trying to get young people interested early and looking at the great opportunities that are available. There is an aging workforce that is exiting, and we're trying to make sure that we're taking advantage of that knowledge transfer before they're out the door, right? There's a huge opportunity. But we got to make sure we're taking advantage of that. And then beyond that, it's trying to be creative, knowing that your competition is probably looking to hire as well. What are you doing differently? And right now, it's just there's so many different initiatives. When you look at, it's not just the job; it's also who you're working for and what does the company stand for. That you need to really focus on and make sure you're marketing yourself on that aspect as well.
And that ties right into sort of the last point that I want to touch on before we get into the Q&A, really about selecting the partners. I mean, it's so important for employees and employers, vice versa, to be interviewing each other, but making sure that it's the right fit. Obviously, that has impacts on if you're having the insurance portion and bonding be a part of your greater financial team to support your business. Again, we talked about it a little bit earlier, but maybe just reiterate the importance of having the right financial team to support you and bringing them into the fold early.
Yeah, and I think that goes back to your point earlier. If you're not setting yourself up for the right succession, the right transfer, exit strategy, and so on, what could you potentially be leaving yourself exposed to? One, with liability, but two, of where's that future support going to come from? So selecting the right partners, again, it goes back to telling the story. Having somebody in your corner that's going to understand your operations and your approach to the business is crucial. It really does set that relationship apart, where you want to make sure you're growing going forward. Trying to bring somebody in new day one, it can be a challenge, right? And again, I go back to likening it to the banking relationship, and how often do you see somebody changing banks? And generally, there's going to be a reason there, yeah. Right? So again, the relationship's key. So whatever you can do on the communication side of making sure there's no surprises, that's the big thing, right? And where that comes into play is having people in place, or consultants or partners. They're going to ask those questions to make sure you're not leaving yourself exposed.
Absolutely. Well, that's I think that's a great high level. I mean, we've given a ton of stuff in a short amount of time, and it's important to note that every every brokerage, every contractor, every surety company is entirely different. So to me, I think it's important to emphasize that, as much as we're giving a high level overview here, that every client will be completely different, whether from their balance sheet, their character, and their capital. And so being able to really have that conversation, open and honest, transparent conversation, bringing someone like Andrew and Trisura into the conversation early, whether you're with them or not, to be able to get the advice, to be able to structure before we even go to market, things that's the type of thing that we do from a risk management to lean on our partners. But I can't stress the importance of truly starting early with a lot of this technical stuff, and that it is entirely different. So for every single client. So major importance. We have a few questions that I want to get into. We talked about it a little bit earlier. Why are bonds better to use to secure a job than a letter of credit?
Yeah, again, it goes back to the point of leaning on the surety's balance sheet compared to using your own resources and setting them aside where they could be better utilized. And as well, when you're looking at contracts that have a bond requirement, you kind of recognize the competition that you're in against, rather than having to be concerned about just somebody coming off the street.
Right. Okay, I got another one here for you. If my company is not an incorporated company, can I still get a bonding account?
You can. But where I would caution you is just make sure that you're talking to legal advice and recognizing the exposures to an individual as a corporation versus an unincorporated company. So I think it's more of recognizing that liability, more so than being concerned whether or not you could get a bonding facility set up.
Yeah, because it's not just your company at that point. You're talking about your personal well-being, your homes, some of the financial guarantees that you have to put in place that could be impacted all over the place.
Exactly.
To get approved for bonding, do my financial statements have to be audited, or can they be noticed to reader?
So with that, I would say depending on the level of support that you require, depending on the level of or the size of your company, that'll probably dictate what level of review that you need from your accountant. And as well, I guess I'd caution you to make sure that you're looking at your operating line terms and conditions with your bank. In a lot of cases there's going to be reporting requirements there. So again, depending on the size, notice to reader, review engagement, audited, there's going to be different aspects to that will kind of dictate that.
Yeah, there's definitely different levels and other interested parties in your business, depending on the size of it, to see whether or not you need that notice to reader or review engagement. And I would suggest that if you're into the bigger contracts, you're probably already doing at least a review engagement, if not a full-blown audit. So that's just good practice to make sure that, again, your balance sheet is strong and the financials are up to date.
Yep.
Last one here, and probably a little bit more technical, but should a contractor default and not finish the job, what options does the surety company have to indemnify the obligee or owner?
Yeah, so in that case, in a situation of a default, as I mentioned now with the legislative forms, what we're looking to have is a pre-default notice or pre-meeting there, where you have a chance to bring everybody that's able to understand the issues at hand. So in the case of an actual default, there's going to be an investigation. That's the first step. The surety is going to look for the information from both sides. It's not one-sided. So the documentation on a project is going to be key. And then also the speed of which you're able to supply that to the surety. Again, that goes back to one of the positives of posting a bond rather than the letter of credit, right? It protects those funds where that's not just going to be cashed by the owner. They've got to go through this claims process. So from there, if it is recognized as a valid claim under the bond, on the performance bond, the surety has essentially some tools that they're able to utilize of either, well, step one would be just remedying the default. It all depends of what the obligations are under the contract. First step would be to try to remedy that default. Second would be to complete the contract through whatever resources that may require. Third, if it does get to the point where we've got to find a new contractor to step in, we would go to market and obtain bids to see that work completed. And then the last option, or not the last option, but number 4 would be essentially paying out the bond. So it would be paying the lesser of the bond amount or the amount to cost, the lesser of the bond amount or the lesser of the cost of completion. So in some cases, it just may be more beneficial to kind of write that check and walk away.
So it's, insurance companies get a bad rap in terms of, claim happens and not wanting to pay. But from a surety standpoint, it's really, we want to complete that job. We really want to get that contract fulfilled and everyone get to where they wanted to be at the start of the process without necessarily having to just pay out a cash settlement or anything along those lines, correct?
Yeah, I understand the bad rep on the insurance side, but it's the business we're in to pay valid claims and support the owners. Essentially, at the start of this, it really is the owner that is getting this bond for their benefit. Yeah. They're trying to protect their funds and see this project reach completion. So they should see it as a tool that's available to them.
And realistically, that, the steps that a person or a client has to go through to get a bonding account, typically because of the results that we see, we can tell that, you're not jumping through these hoops if you're just starting up, or that you're not, of high character and willing to do this. So in a lot of situations, it is an onerous process sometimes to get going. It takes a long time and a lot of sort of behind the curtains to make sure that information is correct. So that someone commits to supporting you in a financial background. Again, you talked about it from a banking perspective. Really, that's what it's got to be viewed as a little bit differently than, just a straight insurance product. Yeah,
that's why it's so important to understand who we're supporting.
Right.
And it goes to the point that the contractor, they're the ones that are the experts in the job. They're the ones that know construction. We're, again, another consultant, another resource available to allow them to be more efficient in what they're doing and allow them to kind of lean on us for our expertise.
Amazing. Well, with that, I don't see any other questions. So I want to sort of turn the floor to you to have sort of a last pitch, closing comments, and any last words?
Yeah, you know what? Throughout our conversation here, the two things that kind of really jump out to me is, one, make sure you're reading your contracts. Owners have definitely tried to pass down as much as they can through these contracts over the years, and just recognizing the obligations that you're signing into and what you're exposed to. So read the contracts, especially you look at escalation clauses or material substitutions, so on and so forth. Just read the contracts. And the second part I would say is kind of what we've been talking about is just communication. Eliminate the surprises, bring somebody in, talk to somebody that kind of understands your business and can help you get to that next level. So communication's key.
Yeah, we talked about from the bonding perspective in our construction webinar, the last one we did, in terms of the changes in contracts. So, I mean, that's fairly substantial through COVID with the timing changes, with different clauses that people are putting in, like an escalation clause. It's vital that companies or contractors understand what they're getting into, and have another set of eyes look at it. Have your team of advisors sit there and say, hey, have you thought about this? Do you realize the implications to your policies, or your operations? So that's a great piece of advice. That's a huge thing and can't be stressed enough. So, well, my friend, I appreciate the time today. Andrew Romer, Trisura Insurance. I really appreciate the time you took with us today to sort of delve into a complicated bit of insurance. So
no, I really appreciate the opportunity, Matt. I think this is great. And you know what, this has been a lot of fun. And if I can help out at all, please let me know.
Well, thank you, my friend. I appreciate it. And we'll be in touch, but enjoy the weekend and get some sleep with the little ones running around. So
no guarantees there, but yeah, I appreciate it.
Sounds good. Well, thank you everyone for joining us today for Bonds 101, a look at the surety industry in 2022. We'll be reaching out soon with the next webinar and next topics. So appreciate you joining us and the continued support. Thanks, everyone.
Thanks, Bob.